So looking at PST and trade versus cash, the easiest way to look at it or understand it is to look at it from an example. It is something that comes up in conversation, especially as there are other smaller competitors out there who don't stick by the same rules that we do. And so we want to look at why accepting PST and trade versus cash from if everything's going smoothly process doesn't really make any difference in terms of the numbers, in terms of the dollars that people cash that they have available. So let's start with that and start with the example, and then I'm going to go into a couple other kind of reasons why accepting PST and trade as an overall client base and working on that basis versus cash makes more sense. So the example, you're going to make $1,000 purchase, and subsequently we're going to have a $1,000 sale. I mean, the order doesn't matter because I'm going to go through the entire cycle essentially of buying and selling. And then for simplicity, we're just going to use a 5% PST. I know that's not the case for all provinces, and some provinces don't even have PST, which eliminates this conversation entirely. And we're not going to include the GST component, which is covered in a different video, if you want to see how that sort of nets out to nothing. So let's look at the example with taxes and cash, which inherently for I think a lot of business owners is just the way that they kind of almost want to do it. And I just want to kind of go through the numbers there. And so if you look at a purchase, when you make a purchase and you have to pay PST in cash, that means that you're taking $50 out of your pocket on the $1,000 transaction. Your trade would go down by $1,000 because you're spending $1,000, and your province, from you anyway, you're not remitting anything to your province. So the province hasn't gone up as a result of you. Now on the sales side, you're getting to collect that $50 from the buyer, but then you're taking that $50 and you're paying it to your province. Now that $50 payment obviously would happen on either a monthly, quarterly, or annual basis, depending on what your filing is. But in any case, as a result of that sale, you would be at zero cash impact. And your trade would go up by $1,000 because obviously they're paying you $1,000 in trade, and as a result of that sale, you have remitted $50 to province. And on a net basis, if you kind of look at the flow of trade, then from the purchase side through, your cash is out $50 that has gone to your province, and because I did a balanced transaction, your trade nets to zero on those two transactions. Or it might be a series of transactions that add up to $1,000 on both sides. So as an alternative, and what we say should be happening, is that the taxes should be in trade. So if you look at on the purchase side, instead of being out the $50 on that side, your trade goes down by $1,050. Your cash is unimpacted in terms of the transaction with the seller. And then the sales side, your cash, when you do the sale, basically you are not collecting any cash from the purchaser, and so you still have to remit the $50 cash on your monthly, quarterly, or annual filing to the province. So basically, as a result of the sale, you're down 50 cash and your province is up 50 cash. Your trade account goes up by $1,050 because the buyer has paid you the PST in trade dollars. Once again, if you look at the net row, it looks very, very similar. Some would say exactly the same as doing the taxes in cash, in that the net, on a net basis, you are down $50 in cash as a result of having to take 50 of your dollars and send them to the province. So whether it's being done through the other party or by you, on a net basis, you're at the exact same place financially, taxes in cash or taxes in trade. But now let's look at some of the advantages or other reasons why you may want to you kind of have to follow our rules or not participate, why we do PST in trade. The first thing I want to do, because I'm an accountant and I have to deal with managing people who process transactions, is if you look at this, you'll realize that in the case of taxes in cash, you've actually doubled the amount of transactions that need to be processed, or the number of lines of transactions that need to be processed, as well as forms of payment that need to be managed. So you're doubling the bookkeeping work of working with BarterPay or another exchange by agreeing with the philosophy of PST in cash versus PST in trade. So it's much smoother and much easier, much cleaner from a bookkeeping perspective to actually work with it all in trade, and then at the point in time where cash is being remitted, there's still just the one payment as always. So if you're looking at the screen right now, there is in the purchase, you have 2 transactions on the cash side, 1 transaction on the trade side. On the sale, you have 2 transactions, once again, 1 transaction on the sales side. The transaction for paying the province would just be the same 1 transaction that you would have anyway, whether the trade transactions exist or not. So it's almost like not a transaction, but just that the transaction value would be higher. So a reduction in the number of bookkeeping entries. Another thing that is missed by some people is that when you are doing it the PST and cash way, you're not in control of the cash. The seller is essentially, and the future buyer is in control of whether or not you get cash. So in the example on the cash side, there is this assumption that you are collecting the $50 from the other party in the transaction. So basically, and if you're a restaurant or whatever, then obviously you're more likely, because you're used to collecting on every transaction, you don't have receivables to be collecting that. If you're used to having receivables, you might be sitting on a receivable now with this person for the $50 they owe you, and so you are out both the $50 on the purchase as well as the $50 that you had to pay to your province when you did the sale, and so now you're in fact out $100 or double the number with tax and trade. Whereas on the tax and trade side, the only time that cash is leaving your pocket is when you're in control of it, which is when you're remitting it to the government. And so from a cash flow money control side of things, it is much better to do PST in trade. As a disadvantage, to acknowledge the disadvantage side, the cash outlay is at the time of the sale, but it is deferred based on your remittance period. And so if you're a monthly filer, essentially it's at the time of sale. If you're a quarterly filer, it might be a few months later, or if you're an annual filer, it's the end of the year. Overall, though, because we basically say that your trade sales shouldn't be more than at the most 20% of your overall volume, it shouldn't be something that's a major impact on your business to remit that the PST potentially in advance of when you would have bought something. And so if you were in the process of building a bit of a trade balance up, then yes, you would have a little bit of PST exposure, but in terms of your overall business, it would be fairly insignificant.